Hey guys, hope you are all having a fantastic day. Today's CPI data came out, showing inflation coming in lower than expected. A lot of outlets have been celebrating this as a major victory, and the market certainly responded in the pre-market with a significant jump. However, I think there is much more to this report that is being ignored. For example, core inflation came out hotter than expected, once again showing a growing trend with higher prices not cooling off. We are going to go over all the information that you need to know with straight facts, and then you can make up your own mind if this was a positive report or an actual bad one. On top of that, today I wanted to go over a looming crisis on the horizon that unfortunately is not receiving half as much attention as it should be, which pertains to real estate. Before we start, I want to invite all of you over to my Discord, which provides a steady flow of profitable day trade alerts. So far today, we have had 3 alerts get filled and have banked it pretty big. We have a lot of catalysts coming up this week, so definitely come over and join. You literally have nothing to lose from this. The Discord is open to join for everyone and it's linked in the comments below. With that said, let's get started. Inflation moderated in the month of March as a decline in gas prices helped cool off the pickup in prices. The Consumer Price Index increased 5% in the year through March, down from 6% in February, marking the slowest pace since May of 2021. This has been perceived as a major milestone by many, and there is good reason for them to celebrate. After all, the numbers clearly show that the Fed's rate hikes are certainly having a good effect at slowing and bringing inflation down, and the possibility of a soft landing certainly increased as a result of this. However, there is a lot of baggage in this report, and skimming through the details will paint a better idea of how the economy performed rather than just a 5% digit. Core inflation. Arguably the best measure to get a pure and clean price trend that ignored food and fuel costs, actually grew by 5.6% from a year earlier. This was up from the 5.5% increase we saw in February, marking the first acceleration in the yearly numbers since September. This has led to a general consensus around investors that price increases are definitely moderating, but that progress is painfully slow. Inflation blew up last summer when it ran up to 9%, and even though it is not at that peak anymore, it is still a dangerously long distance away from the 2% inflation that was normal. Skimming through the details a bit more, this report is kind of mixed. New vehicle prices went up, while used car prices went down. Energy prices fell significantly, brought down by lower utility and gasoline bills. Food prices remained relatively flat compared to previous months. Rent for primary residences did rise again, but more slowly than the reading in February. The 2-year Treasury yield, which is very CPI sensitive because it accounts a lot for potential changes in interest rate expectations, initially dropped following the news in the morning. However, as of me making this video in the afternoon, the yield has returned back up, signaling that the market believes nothing has changed that much, and that the current CPI report, though bullish because it barely beat expectations, still does not inspire strong bullish confidence in investors. This CPI report was greatly attributed to lower energy prices. However, the latest events happening with OPEC can certainly affect energy prices, something we discussed in much greater detail in my last video. If prices for gas start going up as a result of Saudi Arabia and other Middle Eastern countries' latest changes, you can bet the next CPI report will be significantly higher than 5%. From the Fed's perspective, this report was decent, but not good enough to alter their plan to raise rates by 25 basis points to a range of 5 to 5.25% when they meet on May 3rd. What markets now have to wait in is whether this upcoming hike will be the final one or not. Unemployment is still at 3.5%, which makes inflation entrenched. In my non-expert opinion, this report has too many problems in it to make the Fed feel confident. From a methodology standpoint, rent inflation in the core CPI tends to drastically lag market trends on new leases. It could take through the very end of 2024 next year for rents to normalize, which means the Fed will need disinflation to come from other parts of the measurements, in particular core goods such as cars and trucks. We know, looking through the data, that core goods have been a significant deflationary force for the past couple of months, but that trend is diminishing. In 2021, prices of used cars exploded due to the supply shortages brought on by the pandemic. This part of the core goods seem to be turning into a neutral force for overall inflation. The reversal of the used car bubble definitely helped the Fed, but that is at its end now. It's really hard to sort of make any predictions, given that these variables market shave been using to gauge where CPI would be are now becoming less of a factor. The biggest risk for CPI remains gas prices, which are now threatened to rise again with the recent developments in the Middle East. With that said, I await for confirmation with the Fed minutes being released later on, which should provide more or less the angle by which the Fed is perceiving things to be. If anything important comes up, I will talk about it on Friday's video. Now, let's transition the conversation to commercial properties, because this to me sounds like a ticking time bomb. According to a hit piece by Bloomberg, almost $1.5 trillion worth of U.S. commercial real estate debt comes due for repayment before the end of 2025. The question being raised is, who's going to lend to them? Refinancing risks are very front and center right now. The maturity wall here is front-loaded, and so are the associated risks. The risk is very high. Morgan Stanley is now estimating office and retail property valuations could fall as much as 40% from peak to through, increasing the risk of defaults. If that wasn't enough, small and regional banks, which were the biggest source of credit to the industry last year, have been rocked by deposit outflows following the demise of Silicon Valley Bank, which is raising concerns that will crimp their ability to provide finance to borrowers. As Bloomberg pointed out, the wall of debt is set to get worse before it gets better. Maturities climb for the coming 4 years, peaking at $550 billion in 2027. Banks also own more than half of the agency commercial mortgage-backed securities, increasing their exposure to the sector. When apartment blocks are excluded, the scale of the problems facing banks becomes even starker. As much as 70% of the other commercial real estate loans that mature over the next 5 years are held by banks. We are definitely seeing the real estate companies do all they can to deliver, scaling back investment programs, more joint ventures, bond buybacks, and where possible, dividend cuts. A recent report by CNN showed that the majority of American corporate offices are currently half empty. Offices were the worst performing U.S. commercial properties in 2022, and it shouldn't change much in 2023. Average occupancy of offices in the U.S. is still less than half March 2020 levels, which is absurd and goes to show the smugness in the real estate sector. In fact, something that went criminally underrepresented in the media was that in January of this year, Blackstone noticed an outflow of retail investors and wealthy individuals in real estate amid these volatile markets. The IDR Investment Management reported a massive $20 billion withdrawal request from a group of institutional investors' property funds. I don't want to deviate too much from the commercial real estate sector, but I quickly want to note that the problem isn't exclusive to that only. Due to high housing prices, banks are losing money on every mortgage they finance. On average, every mortgage that banks originated in 2022 costs the bank around $301. The whole system is eroded with valuations that make absolutely no sense given the current market we are in. Going back to the commercial real estate topic, office buildings simply aren't in the demand that they used to be post-pandemic. The world is shifting at a high pace towards work from home, and whether you or employers like it or not, it is a trend that is here to stay and here to grow in the coming years. Companies are slowly realizing, or will realize once impacted in the pockets, that good talent will decide how the dynamic works, and if the talent is actively choosing to work for companies that allow them to work from home, companies will be forced, now or eventually, to enact policies that accommodate around these preferences, because not doing so will put them at a significant competitive disadvantage over competitors. As a result of this phenomenon, commercial real estate is going to suffer. I do not know about you guys, but when I have been out, I have noticed a lot of empty offices in buildings. Things simply aren't what they used to be anymore. Keep in mind, a lot of the companies trying to get workers to go back to the office comes from them trying to justify the lease they pay the building owner. However, demanding people to commute to work has a lot of negative consequences. First and foremost, the average car price is now exceeding $50,000. You need to be loaded with money or willing to take a loan to simply be able to afford a reliable vehicle. This puts people in a position where they need to decide the merits of getting a $50,000+ loan or simply take another job offer that lets them work from work. The other is the top performers, which of course have the leverage to choose where to work. Smart companies will realize that to secure or preserve this talent, they need to be much more flexible with their demands. There's certainly been a glut in office space for decades, and that's coming to an end. And something that will exacerbate commercial real estate will be realization by corporations that they do not need so many mid-level employees to supervise others, eating at their profits. Anyone who has ever held a managerial job, heck, even entry-level, knows very well that a lot of companies are overrun with needless managers. How many times have you had managers literally come into work to read emails, go to meetings and micromanage you only to have something worthwhile to report to excuse their job? Companies will realize they can significantly enhance their bottom line by cutting away all these pointless positions, making the business much more efficient, and when more and more companies start doing this, they will realize that they do not need to lease such big offices since they will understand that work from home isn't bad on their bottom line at all. At that point, both employees and employers will have no reason to want office work, and commercial real estate will be in significant trouble. As you now know, there is a looming problem right now with potential defaults on the commercial side of real estate that could worsen the economy in many ways. This is why I, to this day, even with a marginally better than expected overall CPI, still remain skeptical about progress. The main issue I have is the lack of stability and certainty. A recent MarketWatch report said 39% of Americans skipped meals to make housing payments. JP Morgan and Bank of America are warning that the economy is at high risk of shrinking. The banking sector's strength is a huge question mark right now, with bigger banks saying the crisis is not over yet. Whether you are bullish or not, you cannot deny that there is a huge affordability issue going on. People are having a harder time affording things now more than ever in recent history. In this latest CPI report, energy pulled everything down. Services numbers haven't stopped growing, and that is very alarming. If energy prices go back up, CPI will likely go back over 6%. Even at 5%, it is very far away from the target goal of 2%, and as I have said, the longer we are elevated, the worse economic conditions get. This report, in my opinion, was not satisfactory to me because it did not have the overall results that I wanted to hear. Energy might have saved the day, but its future is a question mark, and everything else came out worse, showing a bad trend. But you know what, in the end I am still making money day trading the heck out of SPY. Whether we go up or down, we are absolutely killing it with our day trade alerts, so come check them out. Let me know in the comments below what you think about the video, how you feel about working from home versus from office, and if you feel confident about the economy. I will see you all on Friday for the third and last video of the week. Thank you for watching this through to its end. Have a fantastic rest of your day and to the moon.